Morning, Thursday 18th of May. Let's get into the briefing for this morning, and a little bit of calm after the storm, so to speak. Things considerably more quiet than where we were yesterday, and certainly in terms of a sentiment perspective, as people kind of gather themselves after what was one of the biggest days in market volatility and market movement, and certainly that we've seen in a considerable period of time. We'll look at some of the stats and recap some of the reasons why for that. But one thing that was particularly key yesterday was trying to pick up on market sentiment, and given the lack of scheduled economic data or speakers, anything on that front, what was really key yesterday and what proved quite pivotal, I think, in able to navigate the moves yesterday, one was timing. Timing being that when we came in yesterday morning, the market had already reacted to that latest New York Times article about Trump, and so the risk aversion had already really taken place in the overnight session. Not a great deal really happened during the European morning. It was only until really the US came in that the market then started to really see some much bigger volume going through, and consequently much of the market movement and action really took place. I'd be very much probably looking for the same thing to happen today. What you've got to realize, I guess, with the timing aspect is that this market at the moment is driven by the US economic themes. It has been, although we've had some sidelines of French election, first and second rounds, things of that nature, the snap election being called in the UK, the predominant theme for the last really 6 months has been Trump and this kind of Trump trade, and now this Trump potential situation of impeachment and so on and so forth. And would that then cause a bit of an unwinding of these extremely high valuations, for instance, in equities, where we've been trading as per what we saw with a bit of a pullback in yesterday's market. The other point is that when there is a particularly light economic calendar, I think what's really important to kind of track sentiment is monitoring of risk assets. And typically that's really defined by things like gold and the Japanese yen. And yesterday, by watching those particular instruments, you were definitely able to get ahead of the wave of selling pressure that then followed in the equity market, and then further boosted things like fixed income products on that flight to quality bid. Just to recap with gold firstly, we had already shot up in the overnight session. That was this move. And one of the key things about the timing here was that when that New York Times article actually came out yesterday, was that it came out too late really for US participants to react to it. It was after 11 PM, translating into London time, so a good 2 hours after Wall Street had already closed. Most US participants would have gone home. So Asia Pac saw a reaction to it, but US was still yet to really fully digest the information. So there was this, we talked about it in the briefing yesterday, the possibility that there could be a secondary move to what was seen overnight. And then we did actually see that as soon as US stepped into the market. That was when the bigger moves occurred. Now, looking at gold, I know Michael, one of the guys here, had some really great trades in gold yesterday, and it was a perfect case of all these things we just discussed coming into a perfect kind of strategy, in that you've got a fundamental bias, timing coinciding with the US coming in when you eventually broke that resistance level that was around the R2 on the day. That then, he was already aggressive into the position with some size, scaled out of it most of the position, then went back in, added size, technically at the point of where we originally breached on that previous resistance, and then followed the move all the way up, scaling out the position all the way up to initially, I think it was 1250, then added some again on the way up. So really good execution and a perfect kind of combination of both fundamental for the bias in direction, timing on the market move with the US and the COMEX pit open when the volume is much higher. You tend to get much more sizable movement in the market, and then technically on the entry and exit. So that was definitely a good lead indicator, if you like. And the other one that we were watching very closely yesterday, and I know Vas got hold of this very nicely yesterday as well, was dollar yen. And it was really that 112 handle just above there that I was watching quite closely. And if I start looking a little bit longer dated, it will probably make a little bit more sense. This 112 level here, well, I've got it marked up at 111.91. That was that previous low that was seen in early May. It was that resistance point that was seen in late March. Just mark that up. And just psychologically at 112, I thought, well, if we really get through to that point in this risk aversion, then that could then trigger an extension on the move lower. It did quite aggressively, and then the move just continued to power lower. Some other levels were then breached. This previous low point that we had kind of late February, then saw a further extension of the move, and you can see how this is again, you're bringing together the fundamentals and the technicals in terms of the strategy. Here it breaches that key level, it runs down, breaches again, gets further momentum. When it retraces back like it has done in the overnight session or early hours of this morning, it comes right back to the point of that previous support level before then going short again, and now we're sub 111. So you can see how entries are always absolutely critical in executing any trade, but there's been some pretty good setups for those risk instruments. And what happened yesterday then was when that level we just spoke about in the yen went, that was when at the time the S&P and the other US indices were trading at pretty interesting levels. Still got it marked up here yesterday. This level at 23.79 was really important for this support reason. When we broke that, and then we broke the kind of range low that we had been in for a considerable length of time, then we saw a dramatic fall in prices, and pretty quickly. Likewise, the Nasdaq took out some key levels, and the whole thing, momentum takes over. The kind of short-term psychology is that the kind of herd hits the sell button, and it becomes quite aggressive in nature. The one thing you'll notice yesterday as well, in the way that selling of a greater magnitude tends to happen, is it comes in waves, and that's really important. You get a key breach of a technical level, the market gets forced lower, then you see a kind of mild recovery before then another flush lower. So hopefully for some of the newer traders, you can get more experienced of the nuances in selling when the market's moving lower like that. One thing that was good for some of you is that you managed to stay in that position and just scale out some of the position as we were going down, which is a very prudent strategy in terms of how well you guys did yesterday. A quick look at some charts then that I've seen in the FT this morning that kind of sum up this current situation and this turn of fortune almost in the market, having quite recently been at record high territory not so long ago. First of all, starting off with the dollar, obviously we got to the upper bound of quite significant levels in both euro dollar and cable, as the dollar has retreated quite aggressively from a 14-year high that was seen really at the back end of last year. This was really when the Trump trade or Trumpflation was really the focal point of the market. We've obviously had Trump quite actively looking to talk down the currency, but this latest push off 100 sub 98 has certainly been particularly aggressive on this latest uncertainty on Capitol Hill. Going back to cable yesterday, there was a very last chance opportunity in the session yesterday afternoon, and that was because cable came up to a very key level as well, and certainly we're within 25 pips still of it, and certainly worth keeping an eye on going forward. It's now forming quite a significant marker of this range that we've been in since Theresa May called that snap election, really. And that's that 130 handle. We've tested it a couple times now, so I would be watching that with great interest even this morning in the context that we've got UK retail sales coming up within the hour. But yesterday afternoon, you would have had to been quite aggressive at the time. The dollar was seeing some pretty sharp movement, but we got pretty much bang on the 130 handle. Before then, you saw quite an aggressive pullback of over 50 pips at the time, in quite quick fashion on that key technical level. Euro dollar, likewise. When you start looking at the euro, it's been a phenomenal rise. When we still keep in context of the French election situation. Obviously, the bigger move was on the first round. You had the confirmation of Macron victory, some profit taking on these more elevated levels for the pair. Only then for really the Trump, Washington Post and New York Post or New York Times articles started to circulate, and really this is more about dollar weakness, this kind of last portion of the euro dollar uptick, than it is European fundamentals. But certainly up towards 112 now. It'll be interesting to hear what ECB officials have to say when they start speaking, keeping in mind Draghi is speaking later this evening specifically. So that's your dollar story. The other one, of course, is the equity markets, which were probably the focal point of yesterday, given that we've been tracking up at these all-time high levels. Many people have been looking for potential correction to take place, whether that being a correction and lower, or correction to then, which would be a healthy thing to occur for then the market to make another concerted move higher. Certainly it was one of the biggest moves we've seen in some time. Going off the stats, the S&P hit to the tune of 1.82%, was the biggest one-day decline since the 9th of September last year. The Dow, minus 1.78%, was hit by a similar amount, while the Nasdaq lost over 2.5%, was the worst day since the aftermath of the Brexit vote back on June 24th. Financials were also hit hard, with the S&P 500 bank index down 4%, which is also the worst day since the day after Brexit. Two specific sectors then that we're looking at. One, the bank index almost twice underperforming that of the broader S&P index. If you remember, it's the financials which have been some of the biggest beneficiaries of some of the proposals coming out of the Trump administration on the back of chiefly watering down of regulation, then also this premise of higher inflation, meaning higher interest rates ultimately would be better, more healthy for bank margins. This obviously becoming a situation where a lot of that's getting unwound. Bank stocks that have been up, like Goldman's, in excess of 35% at some points, seeing the much larger proportionate pullback then when the market does decide to make a decent move on the downside. The other index, the Nasdaq, much worse a performance than that, say, of the S&P and Dow. The tech sector obviously has been one of the most heavily bought into. We've looked at the likes of Facebook, Alphabet and so on, the former having risen again in excess of kind of 30% almost year to date. They are the ones that are more ripe for a more sharper correction in that respect. The other thing that moved and has drawn obviously a lot of attention has been the VIX. People have been talking about the VIX. We were sub 10 for a period. We're looking at the VIX, what was it, about a week and a half ago? The VIX printed at its lowest level since 1993. Well, this is the financial markets really, and as a perfect classic example. Things can change very quickly. And that's not to say that the VIX is anywhere near levels that we haven't not already seen before. What I'm looking at here is dating back the VIX to last summer. So a couple of key points of interest here. You can see these flashes of VIX volatility on the upside. This was, of course, the summer of 2016. This first kind of period here was Brexit, which was one of the most surprising events at that point in time. Highly unexpected by the market, hence it shot so high, in excess of 25. Then you had September. That was when Deutsche Bank fears of potential bankruptcy circulating, the Italian banking crisis, that what's caused that blip. Then you had the US election in November and the Trump situation. And then you've had what we've had here, which is an unprecedented period over the last few weeks of an extremely low VIX index. Only then you can see, though, the point being this last uptick and how sharp that's been. Really, to see such a sharp move, you've not really seen that since Brexit in terms of a one-day gain. In fact, the measurement of volatility surged within the VIX, climbing nearly 5 points to close at 15.59. It's the highest since April 13th. It was also the biggest one-day climb in percentage terms since Brexit. So as we just said. So certainly that all of a sudden has kind of jolted into life, so to speak. This again just putting into context what we were just discussing on the sector breakdown and looking at the specific areas that have gained and suffered the most. Obviously if you look at financials here, the election to inauguration, when the Trump trade was at its most ferocious or most optimistic, financials surged, and you can see the difference between the performance of where we've seen post-inauguration. Let's not forget as well, Trump's only been in office about 6 months overall in total. So the amount of movement that we've seen, the amount of headlines that has been he's created has been exceptional and unprecedented in many respects. US yield curve, the flattest since the election. So we're focused suddenly on economic and business risks from Trump's administration's difficulties. Investors obviously seeking the much safer option. So government bonds backing demand as equities come under pressure. So you're seeing a movement out of more riskier assets short term yesterday into more safe haven products. It's not just gold but also government bonds as well. It was the second biggest one-day decline in US yields since after the aftermath of Brexit. So all this pointing to, the stats would be one of the biggest days that we've had in a long time. And I think what's really important about a day like today is a step back, a deep breath, and then a reevaluation of the current situation. And that being in that, history would tell us that very seldom do we see, without any new fundamental things occurring, would we see a simultaneous kind of day after day after day decline. The period when that did happen was the global financial crisis, was the last time I can remember when the market just sold off day after day after day without much real new news. But at that time it was a slightly different sense, that there was genuine fear in the market, where the lack of transparency about subprime ultimately and exposure that banks had on their book, and it was completely a behavioural fear trade that happened. It didn't really matter what the news was, it was just a sell. I certainly don't think we've got to that point just yet. Let's not forget that Trump being impeached has only happened, as we discussed this yesterday, 2 other former presidents, both of which didn't actually go through in the end. Clinton being one, he got impeached, or it got passed by the House but then thrown out by the Senate. And then Nixon being the other famous one with the Watergate scandal, actually resigned before it got to that point. I'd say it's a little bit too early yet to be talking that this is the end of Trump. Paul Ryan, one of the senior ranking officials in the Republican Party, if anything, has given the backing to Trump last night. In the press conference, he's also suggested that if Comey felt uncomfortable with what Trump was saying, well, why didn't he voice his opinion then, and why didn't he resign himself, is all signs of backing Trump, not going against him at this point. So really, you've had Congressman Al Green, the Democrat, I think, of Texas, voice an impeachment of Trump. However, it's when you get senior GOP members that really then this market sell-off could start to pick up some momentum. If then senior ranking officials within his own Republican Party start to voice calls for impeachment, then you'll get a much more consistent move in the markets to the downside, and further fueling this flight to quality move. So overall, I know a number of you had a really excellent session yesterday. What I would suggest is really two things. One, just be mindful of the timing. This is very much a US driven market, as I said earlier. At the moment, when they come in, it'll be interesting to see, after what happened yesterday, how do they now reevaluate and perceive market prices now that we have moved a little bit lower, certainly in the equity space. And so I would probably be looking for them to dictate that when they start coming in around midday. The other thing is, for the new guys, you've got to get used as well, because I know in stage 3 in the career program, this is your first week trading live funds. And about this, getting used to the highs and the lows. That irrational thinking that can come when you're in a bad situation can also occur when you're in an extremely euphoric situation. So again, look at the market each day objectively. If you can, hypothetically, almost press the reset button. Look at where the market is sat technically, reevaluate the fundamentals. Has the situation changed? What is the sentiment? And make your decision. Do you think the market at this point has further to go? For me personally, I think unless we're seeing a little bit of softness in the US equity markets at the moment, I'd be interested to see how the S&P fares here if we see a retest of those lows seen early part of the Asia Pac session. Likewise in the Dow and the Nasdaq futures. But otherwise, I'd be looking for the US to really dictate that for me, to be more telling. Watching gold, yen as well could be pivotal. Okay, away from the US, let's have a look at a few other things. One thing I did see last night is the latest YouGov poll for the Times carried out in the last couple of days. If you remember, the Tory lead over Labour had been kind of 20 percentage point, if not further, when she called the original snap election. A lot of that big gap is what's caused this quite strong move in the currency in sterling, but obviously cable now supported by the premise of the weaker dollar. But what's interesting here is that the lead has shrunk considerably. It's gone all the way down to 13%. Now keep in mind the political scene in the last week in the UK. You had the Labour manifesto first, you've had the Lib Dems yesterday, the Conservatives will be unveiling theirs today. So really, I would say this is probably a little bit more reflective of what the public has been fed this week. That being the amount of press coverage, if you like, or column space has been really thrown the way of Labour, given their unveiling of their latest manifesto. The Conservatives will come. What will be more telling will be how these polls look, I think, from next week. So still a comfortable majority, but a narrowing one. And the one thing that has been quite interesting has been some of the guys putting in the chat room, hashtag grime for Corbyn. Now I know our head of trading, Piers Curran, is very into the grime scene. He can give you the full lowdown. But one thing I'd say is that what this is, if you're not familiar with it, is there's been a bit of a social media influential group, the grime scene, have been trying to cultivate the younger generation to vote by suggesting then that they're going to hold a rave in that you can get free tickets if you sign and register and vote Labour, essentially. I won't go into my own political feelings about the fact that they're not educating people about what exactly they're voting for. I'll leave it at that. But essentially, what this has led to then is cultivating a generation that is more favourable to voting left than they are right. Whether that's had something to play in this narrowing slightly of the spread, if you like, between the Tories and Labour, possibly. I would say more telling will be next week once the Tory manifesto has been unveiled. And let's not forget as well that proportionately the Conservatives as well, and things like UKIP supporters, which were much more in favour the last time round of a general election, the EU referendum and so forth. That party now, all those supporters are going to be leaning conservative. So I wouldn't, again, read too much into this, but I would be tracking it next week. One thing that has been quite interesting, though, that I did see in a chart this morning was about the fact that a majority is still predicted for the Tories. This is a percentage move in the FTSE 350 1 month before the actual votes have taken place in general elections. And so what we're looking at here is the 350, so the 100 and 250 combined, to give you an overall snapshot of corporates listed in the UK. And UK stocks have typically performed better before predictable elections. One of the things we saw yesterday was actually, if you looked at the FTSE yesterday, amid all the selling pressure being led by the US, the DAX, Eurostoxx, the European indices started to follow suit, but the FTSE almost didn't care. And it's almost as if the FTSE is just in a world of its own at this current point, sitting close to record highs. And one of the things here might be the fact that it still is a fairly comfortable margin that the Tories will have a majority, and the more clearer a general election has been, i.e. in 1987, and then more recently, I guess, under New Labour when Tony Blair came on the scene in 1997, the consequent gain in the FTSE 350 has been proportionally much larger. One of the tightest ones that I can remember covering in 2010 had the biggest negative reaction. That's when you get this kind of dreaded hung parliament situation, a political uncertain future, and what it would mean for policies going forward has a dramatic effect. The more control in the lower house, not just for the situation negotiating Brexit, but for rather more domestic policies, the more clearer it tends to translate into people's conviction to invest in the local equity market. Okay, a few other headlines. Australia, although Aussie dollar has pulled back a little bit as we came in to the marketplace, Aussie dollar generally moved higher overnight. So Australia's jobless rate fell in April, adding to the previous month's strong employment gains, reinforcing expectations that the bank won't cut interest rates further. So you did see a bit of a gain, uptick in Aussie dollar overnight, but as I say, it has come back a little bit as Europe's come in. Another headline to be aware of, obviously we've been monitoring ECB commentary for any signs that they might hint towards trying to slightly influence the euro lower off these more elevated levels. You had Coer speak last night, said the ECB should not wait too long before paring back stimulus once it is convinced that inflation has recovered, and it could in theory increase rates early if necessary. So quite surprisingly more, I'd say on the balance, neutral to hawkish at this point. And this was in an exclusive Reuters interview. I did send this out to you guys, so if you want to have a read, please do. Okay, so just to round things up, we'll have a look at the calendar for this morning. You've got UK retail sales, kind of wrapping up the major economic data that you've had from the UK this week. Just to encapsulate the week as a whole from a UK perspective, you obviously had on Tuesday the UK CPI reading, year on year 2.7%, slightly above expectations, the highest inflation rate since September of 2013. You've then had yesterday the latest wage data. Unemployment dropped, actually lower. We're in multi-decade low level in terms of unemployment, more jobs, but people effectively not getting paid substantially more. In fact, UK real wages dropped for the first time in 3 years. This is that longer term play about why potentially 130 or just above could be ultimately about as far as the cable currency pair will be able to go, because ultimately as time goes forward, inflation is still expected to incline further from here. It's going to put even more pressure on households, and with wages, real wages now negative for the first time in 3 years, this is probably only going to be a situation that's going to get worse, and you layer on then political uncertainty with the whole Brexit negotiations still yet to really play for. Retail sales then is going to be really important to monitor in the months going forward. The one I would say caveat with today's report is today encapsulates the Easter period. And so we are looking for, certainly from a month-on-month perspective, positive 1% after what was a negative 1.8. This is what we're looking at here. So last month we had quite a dramatic fall. Expectations were for just a 0.2% fall in last month's report. It came out at minus 1.8. It was much worse than expected. Now Easter probably will help out here a little bit, but it'll be interesting to see this tracking or this data going forward to the health of the consumer, which is critical, obviously, giving a service-driven industry and internal consumption for the prospects of the UK economy and growth going forward. Other than that, you've got the ECB minutes. That'll be at 12:30. Very rarely is that a market-moving event, but it always should be monitored. Then in the afternoon, the continuing jobless claims, initial jobless, I would say these are fairly insignificant in the context of, I would imagine, the market will still be driven by the ongoings on Capitol Hill. We're still yet to really hear from more politicians within the Republican Party, which we're more interested in, as to what their feelings are about this present point on Donald Trump. Philadelphia Fed Manufacturing Index could be interesting. That's also coming at 1:30. Of course, we had Empire Manufacturing earlier in the week. It was a negative print, the first time since October of 2016. So whilst also uncertainty is becoming more and more elevated on Trump, at the same time, economic data in the US has shown, the exception being industrial production, but generally speaking, we've had lower inflation, we've had weaker economic data coming in. This hence the reason why the market took it as quite a decent point to see some fairly aggressive selling in yesterday's session. What had been phenomenally period of strong economic data post-Trump is now starting to soften, coming at the time of the most greatest uncertainty surrounding his presidency and his administration. Speaker-wise, you got ECB's Mersch. Haven't really heard anything this morning thus far, but is speaking again later. Lautenschlager, one of the more leaning hawkish members of the ECB, will be speaking at 1:45, and then you've got Fed's Mester speaking, who is a non-voter and hawk, at 6 p.m. in a separate event in Israel. ECB's Draghi is speaking as well. That could be interesting for the euro currency. Okay, guys, going to leave it at that. So have yourself a good session. Again, I would stress, just be objective, reevaluate the situation for today. Today's a new day. Have a realistic expectation of this morning. I would say you're probably better served, unless these US equities start breaching already technically the lows from yesterday, for waiting until the US come in and seeing how they want to take this market, whether they want to push on from the trend that we saw develop yesterday. Therefore, I'd be still monitoring those products like gold and yen quite closely, and then just taking it from there. Okay guys, have a good session.